Really excited and happy to invite our dear friend Anush Kapadia, professor at IIT Bombay, who has been working on this book, and we've been anticipating it for quite a while. In fact, we wanted him to talk about it last year, but he said it's not quite ready yet, and this year it's published as of January. The book is entitled The Political Theory of Money, and Anush, we're quite happy to hear your presentation. We have quite a bit of time for the session, so take all the time you need. And we're also looking for an elaborate discussion. I think there's a lot to unpack here. So thank you very much. And Anush, the floor is yours.
Well, thank you, Jay. And thanks to the organizers for inviting me. I've obviously been to the sessions multiple times, and it's really a kind of one of my home-based communities. And so it's very special for me to present this work, which, even though it's published, there's a lot of moving parts to the theory, and if one would be foolish to say any theory is complete. So there's, even though it's published in this form, I still find myself going back to it, thinking about it, and so there's, I'm sure, a lot to learn and discuss from today. So it's a very special occasion for me to be presenting to this group, and I will hopefully get to talk about the cover as we go forward. So I'm not obviously an economist, and I come at this as a question of social theory and trying to understand the shape of the system. And so if it's a political theory of money, what is a theory of money, right? What does the theory of money do? It tries to ask in a kind of social theoretic way, what is the nature of money, or the ontology of money, to use a fancy technical word, and why do seemingly insubstantial things, promises, paper notes, ledger entries, have sort of real economic value? And that's a kind of obviously the entry level question about money that we all puzzle over when we come into this strange, when we sort of think about this strange object. For me, especially learning as I have so much from Perry's work, what puzzled me and what got me to write this book and think about it, and I'll talk about the organizational book in a second, is the question of hierarchy. Hierarchy always, the fact that the system was hierarchical, whether it's public or private, whether it's clearinghouse capped or central bank capped, whether in fact the central bank is a private bank or a public bank, and so on and so forth, it's always hierarchical. And that's just kind of stated. And then we get the distinction between inside and outside money and the gearing that has various institutional layers to it. And we're off to the races in a kind of dynamical analysis. But this kind of basic question as to why it's hierarchy, right? It's hierarchy to begin with, kind of bugged me, and I puzzled over that question. The other thing that I think a robust theory of money has to do, and many of the existing theories of money are sort of, for lack of a better word, Eurocentric in this way. They're accounts of strong money. They're accounts of why money works. They're not really, you also need, that same account should also be an account of why money breaks down, but also why there's such variety of money between working, say, as world money and breaking down. There's, of course, a universal variety. So I think part of a good theory of money also has to account for this variety in money, hierarchy in money, different qualities in money, why some monies are better than other, is as much part of money's reality, money's ontology, and monetary systems ontology, as the instrument itself. And so that was also a kind of, if you like, something that sort of bugged me. And the way I want to approach it is to ask this question of functionality. What is required of money? And this requirement is sort of one of the large points in the book, is that ultimately this requirement is bedded in a kind of the kind of society we have. The kind of money we have comes out of the kind of society we have. And it's embedded in a sort of institutional makeup, and the current institutional makeup can be characterized as democracy plus capitalism. But I want to bracket that for a second. So assuming democracy plus capitalism in its various forms, I would include China in that, I would include authoritarian states in that, and I can discuss that definition of democracy further on, and I do so at length in the book. So assuming that kind of broad envelope, what then is required of money? And I would say three things, and they're not the usual three things that we think of. One is stability, right? This unit has to be basically stable. We have to be able to transact in it. It has to also function as a source of, if you like, discipline for a credit system. This, if you like, is the kind of currency schools problem, right? And I take bits and pieces from different schools of thought, as we'll see going forward. The currency school problem, in a sense, is a problem of value. How does this thing kind of, right, endure? The other attribute that it has to have, of course, is liquidity. And that means that it has to be available to transacting. It has to be readily available. It has to be able to be created and destroyed subject to stability. And this has to happen both to satisfy the daily rhythm of commerce and trade and manufacturing, the daily life of an economy, but it also has to happen in an emergency when crises happen and liquidity sort of runs away. How is liquidity stably provided? Both, so, and this is, of course, the daily problem and the emergency problem are both there for businesses, but they're emphatically there for government. And I go at some length in the book describing how our friend Bagehot was keenly aware that the Bank of England was a political construct in order to fund, he called it a Whig institution because the city was Whig. And it supported the Glorious Revolution and a particular political settlement in the UK at the time. And this so this is Bagehot's problem. And this is, of course, the moment of elasticity and the trade-off between discipline and elasticity and stability and liquidity. And the other feature that it must have in order to function well for both democracy and capitalism, if you like, for both businesses and governments, is granularity. And this is that it has to function as a means of payment in a social space, in an economic space that is very unevenly dense. It's a very unevenly dense forest. It has little nooks and crannies and little bylanes, and it has to get to all of these little granular spots of the economy in order for it to be an economy. Otherwise, they're just different isolated little islands. And this, if you like, is Hayek's problem. The idea that information is distributed in an economy. It's a little bit of a flat ontology, Hayek's idea of how the system works, but the intuition, I think, is correct, which is that if all money were provided centrally and all liquidity were provided centrally, this is, of course, the big problem with cryptocurrencies, is that unless you have a granular credit system that reaches into the kind of, into the little nooks and crannies of an economy, it's not going to function very well as money. So then the question is, what instrument, what set of institutions generating this instrument meets all these requirements simultaneously and, to more or less better effect? And, after a series of kind of historical, institutional, political experiments, and I will emphasize the political in a way that I'll outline, we've hit upon this instrument, which I think has a lot of, if you like, evolutionary fitness, which is that it's a credit claim. The money instrument is a credit claim, but it's institutionalized and aggregated in a very particular way. And the way in which it's institutionalized and aggregated gives us a lot of variety, because there are different ways of doing this, different ways of achieving these kinds of aggregation. But broadly, there are kind of two types. And that this credit instrument that works as money sort of simultaneously combines two types of institutionalization or aggregation. And these two types are political, what I call, my term for institutionalization and aggregation simultaneously is mutualization. There are two types of mutualization simultaneously going on with money. The first is political mutualization, and the second is economic mutualization. From political mutualization, we get the features of stability and liquidity, especially emergency liquidity, that you can, of course, as Minsky says, anyone can issue money, but in an emergency, especially as we heard yesterday from Dan's paper, the emergency moment is really when the instrument and the system is tested, and can you do it credibly in an emergency? And political mutualization gives you that. Economic mutualization gives you stability of another kind at another scale, liquidity of another kind at another scale, I would argue, different from political mutualization. But unlike political mutualization, it gives you the granularity, again, especially at the daily level. And so we've combined these two types of mutualization because the features that they give us are between them, we get all the features that we want. The trick is that both types of mutualization, in and of themselves, and the way these two types of mutualization are articulated together are political outcomes. And that's what makes this a sort of political theory of money. So in what way are they political outcomes? And just to take a step back here and talk about my methodology, if you like. The way I get to this, the way I've kind of arrived at this thinking about the system is to really combine two elements of the old American institutionalist tradition. One comes from sort of Commons and Unger, and the other comes from Perry and the banking school. And I sort of combine these two ideas together to help us think about institutions and monetary institutions in a particular way. So Commons and the old institutions thought of institutions as aggregations of contracts, as agreements, as political settlements. And they were political settlements even when they were economic contracts. Politics here, not talking about party politics, but politics as kind of dispute between different stakeholders. And institutions as rules of the game, formal rules, informal rules, norms, and so on, he saw as kind of temporary suspended political disputes. So there's no deep reason why take any rule like, capital adequacy ratios or degrees of capital control or any regulatory you can think of, minimum wage. Yesterday, Perry talked about, the wage dispute and so on and so forth. Literally any institution you can think of, there's no deep reason why it should be thus. It's just, it expresses an equilibrium of disputes, but different stakeholders are fighting over the setting of this. You can't fight forever. Different people have different abilities to keep fighting has to stop at some point. The point at which the politics freezes is where the institution sort of temporarily rests. Frozen politics, as Roberto Unger calls it. Roberto Unger coming from the kind of theoretical legal tradition, which itself has its roots in American institutionalism. And so this view sees this sort of, I feel like the ontology of institutions as temporary force, but politics cools down, we get an institution. But politics can heat up again, and the institution will relitigate where the institution should be, and that will freeze down again and congeal at maybe another place. And so the whole institutional landscape of an economy, both public and private balance sheets, is, if you like, a set of congealed, frozen political kind of disputes. And so, as I said, the sort of ontology of institutions is itself political in that way. But you combine that, of course, with what I've now decided to call the balance sheet view, not taking it beyond the money view, to think about it as a way not just to see money and a monetary system, but to see the economy itself. And of course, I don't need to introduce this idea to this audience. All units, all institutions, in addition to being political settlements, are also two-sided balance sheets subject to a survival constraint. There's cash commitments, there's cash inflows. And so the entire economy is a sort of set of asynchronously interlocking balance sheets. And so these are two elements, as I say, of the institutionalist tradition that I bring together in this idea of mutualization at scale. And so if you see interlocking, of course, as one unit's asset is being another's liability, when you aggregate these, certain balance sheets are able to kind of aggregate claims on others' balance sheets. And this brings certain balance sheets to scale. And this gives them, because they've aggregated credit claims on other balance sheets, their own liabilities tend to be better than others. So that's one of the sources of, initial sources of the hierarchy, is sheer scale. But it's not just scale. It's also how this aggregation is achieved. Is this aggregation of credit claims on other balance sheets achieved by a political contract, if you like, or a set of economic contracts? So the term political is doing double duty here. Political contracts are society-wide political bargains, like a social contract, like a constitution, the way in which kind of taxation, representation, those kinds of things are ordered. So that's a kind of macro-political sense of political, if you will. But there's also a micro-political sense of political, which is that even in economic contracts, of course, there are kind of disputes as to how the contract ought to be configured. And so credit claims of both kinds are also political settlements. And so that gives you a kind of link between politics, the institutional expression of political settlements, and then kind of money and the credit system dynamics that then come out of. So politics configures the institutions in a particular way. Those institutions are frozen, and then those institutions start generating their own dynamics. And so you can read the sort of outcomes, including the quality of the money itself, as a kind of as a product, if you like, of the underlying political settlements read through the institutions. So this is, these visualizations are actually not in the book. And one of the reasons I was happy to be invited to do this is that it gave me a chance to think about a few visual aids here. And so I've shown you a political mutualization. We want to think about that as, if you like, the subject of fiscal sociology, how the fisc and the treasury of the state is articulated with society, how are social compacts made, who's agrees to be taxed, what is the political deal they cut in order to be agreed to be taxed, that whole set of things. So there's internal variation there, but that's a whole other set of binding material, if you like, to aggregate a set of credit claims. And then you have economic mutualization, which is how the credit system is articulated with the real economy. Each one of these varies internally, so you can have better and worse political mutualization, more and robust or less robust. As I say, this is the entire subject of fiscal, or if you like, comparative fiscal sociology. And you can have more or less economically bounded balance sheets together that are more or less articulated into a real economy. And these can themselves operate at different scales. So smaller economies, larger economies, and so on. So that gives you already a space of a very large space of variation. But then these two forms of course, we are familiar with this idea from Perry vis-a-vis essential hybridity. But I want to stress that this hybridity is not hybrid between public and private, because, of course, in the past, central banks have been private entities, and you can have, as we know from China, India, and other places, commercial banks which are publicly owned. So and so on. So the point is not the ownership status of public versus private vis-a-vis the hybridity. It's these two types of mutualization and the different work they're doing and the different kinds of IUs they can generate. And then those two are kind of brought together, and the terms on which they're brought together and how they're locked together through the power constraint, as we'll show, through the credit control mechanism, itself is subject to a kind of political dispute. And so there you have another variation, a dimension of variation, which can vary independently of these other two variants. So you get this, it can various congealments of political settlements at different points in these two types of mutualization, and their articulation give you then an account of both variation and hierarchy. So that's a big picture. Let me drill a bit deeper into this idea of mutualization and then political versus economic. So I want to break down credit and credit claims into two components. The robustness of the claim, what I'm calling the robustness of the claim, which is how costly is it for the counterparty to renege on the claim? What costs are imposed? The greater the cost, the greater the robustness. And the value of that which is being claimed. What are the assets on the other side of the balance sheet? What is their scale? Another way of saying this is that how far in the future do these claims subsist, and so on. So I've highlighted here these two different kind of dimensions, and I'm calling them dimensions because they can vary independently of each other. So Unit B here has a claim against Unit A. That's Unit B's asset. That's Unit A's liability. Now, would you rather have a weak claim on a large amount of money or a large amount of value, or would you have a strong claim on a smaller amount of value, right? The point is that these two can vary independently, right? So the strength of the claim can vary independently of the value that is being claimed. And in economic mutualization, this is sort of, if you like, deals between economic units, again, these can be private or public. You can have a state-owned steel mill and a state-owned bank. That would still count as, or a state-owned steel mill and a private bank. That would still count as economic mutualization. The question is that relative to political mutualization, the costs for reneging on these claims are relatively lower. They're the subject of commercial law, civil penalties, or if indeed they're criminal penalties, they tend to be lower criminal penalties. Whereas political mutualization is when balance sheets, economic units are sort of, if you like, dealing with the state. And there the costs for reneging the claim are heavier. And they are typically the subject of criminal law and so on and so forth. But they are themselves embedded in a broader political settlement. So this is economic mutualization. This is very familiar to us. A supplier will have bills receivable. A company will have bills payable. That's basic economic mutualization. Citizens have taxes payable. The state has So there's still balance sheets. They're both using this kind of balance sheet method, right? So from one level of abstraction, they look the same, but in fact, qualitatively, they differ. They also differ quantitatively because the catchment areas of these particular economics networks will be very different. So aggregators of credit claims can issue money, right? As I say, political aggregation, and this is a kind of, but these two forms of aggregation are different. This line I've taken from one of Perry's older articles, where he says, through political mutualization, we own part of the state, but because the state owns part of us through ongoing taxation claims, we sort of own part of each other, right? This is a paraphrase. He says actually much nicer in the article. The state is a financial intermediary, and the point is precisely to apply this kind of balance sheet logic and the logic of claims aggregation to political deals as well, right? Is that the problem with chartists is that they don't see the state as subject to a political settlement. The state can't just tax like it likes. People come onto the street. If taxes go a particular high, higher than people want, there's protest, right? And so you have to have, as I say, social compacts or political deals that enable taxation to happen. And you can't simply raise or decrease taxes independently of this kind of politics. There has this entire politics of fiscal capacity is embedded in what the society will politically bear, how legitimate the state is. In India, unlike in the US or in many countries, avoiding tax is like the national sport, right? And that's true of many countries in the developing South. So the ability to kind of get people not just to have a coercive state, of course you require coercion and surveillance and all of that, but you also need a certain kind of, all the coercive powers are not going to make the state legitimate, right? And this is a very old Weberian idea of the state having the monopoly on legitimate coercion. And this idea of legitimacy is simply downplayed by the chartists, and this is where all the action is in terms of political mutualization, being able to operate in a robust fashion, articulating the fisc into society. Economic mutualization also, as we know, banks are not mere money lenders, but they accept the creditworthiness of individuals. They exchange and replace their own IOU with that of the individual's IOU, and thereby they kind of socialize credit. They're replacing a kind of more socially legible IOU with an individual illegible IOU that sits on the bank's balance sheet for the duration of the loan. And they do this at a certain scale, not at the same scale as the state does with taxpayers, which makes their catchment areas smaller, but they certainly do it at a larger scale than individual businesses even, and individual households. And so that makes them also aggregators of credits through their loan business, but of course through their on the deposit side, they accept people's deposits of outside money and promise to pay them back on demand, so they aggregate on the liability side as well. And so, so they aggregate through economic mutualization and through using different kind of binding material, if you like, not political binding material that locks people together in a state contract more solidly, but in pretty strong stuff that can, approach asymptotically a kind of political mutualization, sometimes even surpass political mutualization. As I say, India's political mutualization can be weaker than Apple Computer's economic mutualization, if you like. So you have to look into but they remain qualitatively distinct. And then, but both of these forms of mutualization, what they have in common is that they are anchored in the production of value, or anchored in production of value to some extent. And what I mean by this is that within the mix of this interlocking set of balance sheets, as we saw yesterday with the paper on inflation and the fourth price of money, you have to have a degree of non-financial balance sheets whose assets are not simply someone else's liabilities. Because, of course, what finance does and what money does, and what we've learned from Perry and Minsky and so on, is that it can move the survival constraint around. But it's going to sit somewhere. Ultimately, for the survival constraint for society as a whole to be relaxed, you need some set of balance sheets in there where they're producing more stuff or more value. And that is ultimately, and I'll show you the balance sheets, what is anchoring both sets of mutualization, again, albeit to differing degrees and with differing robustness. So when you get these scaled up sets of mutualization, they can issue more credible IOUs, different from each other, subject to the variation we saw earlier. And the IOUs of very robustly mutualized aggregators can be money. Sorry for the hokiness of this diagram. It's meant to be balance sheets of different sizes, different shapes and sizes, but you can see at the kind of extreme left of the picture that ultimately there are kind of assets there, if you like, a kind of a set of real balance sheets that are anchoring through. And this is meant to be at a smaller scale than this, which is political mutualization. Again, same balance sheet structure, different color of the linkages here is meant to indicate the different type of bonding that is holding them together. This is meant to be happening at large, if you can imagine it's happening at larger scale. And of course, the state's IOUs are bonds. Those are non-monetary IOUs. In order to make those non-monetary IOUs into something workable as money, you have to issue money-like liabilities against them. That's the banking function, and those things are concatenated together. So the claim here is that money has value because it is, if you like, a claim on GDP. And it's a claim on, and of course, the claims can be, as I was saying earlier, there's two dimensions to the claims. They can be more or less robust, and they can have a more or less value to them, right? And that gives you an account of variety in money, right? So these balance sheets interlock. The central bank issues money. It has assets on its asset side. The state has those liabilities. The state's assets, if you like, are taxation, subject to the political settlement. The national economy has GDP as its assets, and it is throwing flows of kind of value going forward in time, throwing off those flows, and a portion of that is, if you like, pledged to this collective entity called the state. By analogy to this, a commercial bank issues bank money against IOUs that it swaps with individuals. Those individuals are also citizens, not just borrowers, or taxpayers if not citizens. So they have liabilities to the state in addition to liabilities to the bank. But somewhere they also have to produce more GDP in order to then earn the money to pay back the loans. Just like as a whole, you have to produce GDP to kind of pay your taxes. But of course, you have the power constraint. And again, I don't need to explain this to this audience, but the bank money is denominated in national money, and bank promises to pay depositors X pounds, if you like, on demand. This entity called bank money, of course, used to be in note form. It's now in ledger form, but we're familiar with that idea here, and it's legally fixed to national money at par. Indeed, it's so well fixed. This is a little bit like the Eurodollar. What's happening, of course, in the Eurodollar market is also happening with banks. That you don't see that fluctuation in price, but that's very much happening. That fluctuation is happening, if you like. There's a shadow price of bank money on bank balance sheets, and of course, we know that the price of, say, Citibank dollars or HSBC pounds can drop below. They can break the buck, and if they break the buck too much for too long, they're insolvent, and then the depositors may not get 100 cents of the dollar in the bailout and so on and so forth. But there is variability there. But that variability happens, as it were, in behind the walls of the plumbing, and we don't see that, and so we don't even know that or sort of intuit that there's a distinction between bank money and I call this the kind of fetish of national money, that we just think it's this instrument of the state, but of course there's all this gearing behind there making it work. So this is precisely that, right? We have these two forms of mutualization synced together and operating in lockstep. We have this fixed exchange rate between bank money and national money, the power constraint, and that articulation. We'll talk about that in a second. But in fact, we can only see that articulation if we rotate this kind of object. What most users see is just the object, as it were, in two dimensions. They don't see this distinction. They don't see the distinction with money. And that is not some kind of conspiracy, if you like. That is functional. Complex systems. Perry talked about money as infrastructure yesterday, and I thought that was an excellent analogy. Because with infrastructure, you need to black box complex infrastructure in order for it to work. Indeed, if you don't want black box in the infrastructure, you lose, in a sense, faith in the infrastructure or trust in the infrastructure. You don't need to know how an engine works. You just need to know that if you push these pedals and drive the car, it functions, right? Bagehot has a very nice way of saying this. He's like, listen, as a banker, I don't really need to worry about the ontology of money or how it functions or anything like that. Or I just need to know, what do my creditors need? You want greenbacks? I'll get you greenbacks, right? What is that? What do I need to relax my survival constraint? That particular instrument is valued for a whole set of other reasons. Yeah, that might be very interesting to social theorists and so on. But as a matter of daily operation of the system, it requires to be just, okay, black box. What do you need? This is what will meet the survival constraint. This is what will get me coffee at the store, etc., etc. So, of course, the black boxing is undone when the car breaks down or the plumbing breaks or the infrastructure no longer works. And then, there's this distinction and so on and so forth. There's a power constraint. And then we find out more about how the system works. And of course, that articulation, when it breaks down, it's because this articulation between bank money and national money has come under some kind of strain. But we can already see that the strain is a little bit built in, because bank money is just not as creditworthy as national money. Even though most money is bank money, it's sort of like saying that the rupee should be pegged to the dollar at 1. But the rupee is just not as good as the dollar, right? It's not as valuable. The GDP of India is not that as much as the US GDP. The banking system, as well articulated, the fiscal compact is and on, right? But if the rupee is pegged to the dollar at 1, then India has to generate some dollar cash flows, right? So this is the power constraint is actually very stringent discipline for the banks. They are money market mutual funds where their promise not to break the buck is really kind of hard coded in, right? And indeed, the banks would fail to operate under this stringent discipline unless they were networked together in a particular way, unless they had interbank borrowing and lending from other people, unless the whole thing functions as a network, unless there are hierarchies of banks moving credit around so that the power constraint can be met. But in achieving this power constraint and therefore networking the whole banking system together, in this kind of interlocking set of hierarchy, ultimately capped by the central bank, that can generate the actual stuff that is being promised by banks. Because of this network architecture, which emerges from the stringent discipline of these two qualitatively distinct instruments, bank money, Citibank liabilities are just not as good as Fed liabilities. But Citi promises to pay their bank money out, their promises at 1 for 1, right? So this is the severity of the power constraint. In order to do that, they network together with other banks. They have backstop arrangements with the Fed, et cetera, et cetera. But that networking then means that market discipline fails, and that you simply cannot have actual market competitive discipline. You can have it up to a point, but there is too big to fail. There's too interconnected to fail. There's moral hazard. Again, this is independent of the ownership status. We can see this in China. We can see this in India. Banks equally, are too big to fail if they're public or private. That's a kind of detail as to how the dynamics work. That's not an in principle kind of issue. And because pure market discipline fails, you have these control mechanisms, which, being institutions, have their own attendant politics that are meant to lock private money or bank money and national money, lock them together in lockstep and make sure that power is kind of cared for. And these, of course, we are familiar with these interest rates in interbank credit markets, lender of last resort, bank licensing, bank regulation, the whole kind of set of things that articulate these things together, right? And this articulation itself, as I say, is subject to a kind of political equilibria. Perry's older book, and his first book, if I'm not mistaken, is The Money Interest versus Public Interest, that political equilibrium shows up in how well articulated the two forms of credit claims are. So you get these hierarchies, therefore, from varieties of robust mutualization. Within states, political mutualization is more robust than economic mutualization. That's the claim, for reasons I've stated already. They have greater scale of the assets, more robust mutualization between balance sheets. Why is this different from chartalism? Because it's based on this idea of aggregation of claims through on future value through mutualization, and as institutions as kind of frozen politics and balance sheets simultaneously. It's not in the chartlist account, and this is why they, in a sense, lack an account of the variation of money. It's simply a sovereign imposition of a tax debt that gives value to kind of chartal tokens, right? The state says, I impose a tax on the citizens. The sovereign says, I impose a tax on citizens. And oh, by the way, here are all these tokens that I will use to buy stuff with, and you can adequate your tax claim and cancel out your tax claim by spending these tokens back to me. And therefore, the sheer imposition of a debt through kind of sovereign imposition has given actual economic value to a valueless token. Now, there is some merit in that. It's not that isn't true. People will keep money balances of chartal tokens to pay back to the state, of course. But notice that there's no political settlement there. It's a mere imposition. And so there's no variability even in between states there. How do you account for different degrees of sovereignty? But even then, it misses out all of the banking kind of apparatus, and therefore doesn't quite get to, you would get stability, but you wouldn't get day-to-day liquidity and granularity with that. And so you would have a kind of a lopsided credit system, and a pure chartal system doesn't give you a full account of money, and it doesn't give you a full account of variety. But also the very logic is just politics and not mutualization through settlements and so on. Now, between states, that's within states, but between states, as we've seen, you have varying combinations and varying degrees of political mutualization, of economic mutualization, and the articulation and scale that gives balance sheets of different. Sorry, there's a typo there, of different combinations, different monetary potential, which means that some economically mutualized balance sheets can, in fact, issue better money than some politically mutualized balance sheets. I've already said how that's the case, right? It depends on where in the space of variation you are. But it also means that it also gives us, if you like, an account of world money, that the sort of political economic mutualization combination that's most robustly mutualized at the greatest scale will issue the best money in the world, which will then be used indeed far beyond the domestic jurisdiction. It has, if you like, a surplus of creditworthiness, and it can be used and circulate kind of globally. So I'll just wind up here with an account of, that's the first part of the book. So the book is arranged as, and there's different bits of the theory. I've just gone over it in a very quick way. That's the first part of the book, which is the kind of, as I say, the theoretical part. The second part is a series of case studies that try to operationalize the theory. But of course, the theory, it's written as if the theory is first and the case study is second. In fact, of course, the case studies throw up different elements of money and different elements of this, and therefore it's the case studies that come first, and then you try to make sense of the case studies by a kind of a theoretical generalization. So I'll just do a little bit of operationalizing this to give you a sense of how I've used it in the case studies. I have 4 case studies in the book, and they are the US shadow banking system, the emergence of the crisis of 2007-8, the global reserve system, bitcoins and cryptocurrencies, and the euro crisis. And I'll go through each one of these very briefly. in the US, the kind of political mutualization has certain characteristics to it, right? It's obviously has a very strong political mutualization, but it's over time through, if you like, the neoliberal period it has been weakened, but it's still robust. You have the specter of kind of rich people and upper classes moving their money to tax havens. You have the fiscal brinkmanship of the Republican Party. You have a kind of atrophying of the fiscal state, and a deeper kind of fraying of the social contract in all kinds of ways. But the Treasury is still deeply articulated in the U.S. economy. On the other side, you have a market-based credit system, of course, which is off balance sheet in the shadows. A lot of it, too big to fail, operates. You have a kind of monetary populism, by which I mean that unlike, and this comes to the kind of democratic part, under the gold standard, where you didn't have democracies, but of course you had very well articulated financial system and the gold system, the gold standard, and which is of course a sterling system. The sterling system appeared to liberals of the moment as automatic because the systems, the central bank had a credible commitment to crash the economy if flows moved in a certain way to threaten parity with gold or threaten the kind of gold coins. And of course, if the flows are in such a way as to threaten the parity with gold on the downside, say there's too much gold outflow and so on and so forth from sterling, say, what the central bank will always do is there's a credible commitment to raise interest rates, draw gold back in, and shore up parity. But of course, raising interest rates crashes the economy beyond a certain point, or it kind of limits the fisc, and it also limits businesses. But because there was no democracy, there was always credibility that the Bank of England could raise interest rates to whatever rate required to encourage flows back in and defend par, right? That ability of central banks to kind of credibly commit to smash the system went away with democracy, both in the global north and in the global south. And so that's been replaced by a certain incrementalism, or even a kind of Greenspan put, leading up to a refusal to kind of allow the system to go into deep crisis. Of course, spiraling crisis hurts everyone, but even a modest depression to kind of wring out the excesses of the system, or as Perry says, to kind of get rid of ZERP businesses in the current cycle, even those are kind of seen as, notwithstanding the nominal independence of central banks, there is a kind of common sense that that's not allowed. And so that gives the system a certain kind of characteristics, what I'm calling this monetary populism. And of course, these part of the crisis that emerged was that tools to control the system were configured for a bank-based system, but the system had evolved to a market-based system. And so you need to adapt those tools, and those tools were adapted vis-a-vis market maker of last resort and so on. Now, of course, the scale is huge. It's 20% of approximately still 20% of world GDP. So you have this tension in the US between a weakened but still robust fisc and a kind of market-based credit system. And you have this gearing between shadow money and the US dollar. To some extent, the credit crisis was a result of a lopsided kind of underlying political settlement between the money interest and the public interest that weakened credit controls, and that allowed a kind of hypertrophy of the banking system that then had to be kind of corrected, some combination of correction and bailout to kind of keep the articulation whole. But that articulation was weakened through a certain underlying political settlement, which entailed both crisis and capture. So you can see how a certain political settlement led to a certain kind of macro dynamic. There's been this debate around world money. This is now one of the other kind of case studies that I use, and talking about why it is. And this is a constant sort of cry you hear on the left in terms of this more progressive political economy spectrum, which is that, why isn't the SDR allocations kind of used more? At some point, even after the crisis, the Chinese central bank has stated this. The problem with the SDR, and why the SDR is such bad and in principle why it's bad. You can probably use it at the margin if you like for certain things for smaller countries and so on. But to use it as kind of actual money, it lacks all of the mutualization, both political and economic, and is just virtually a non-starter. The SDR is a liability of the IMF. Different countries sort of pledge different amounts of quota of funds to the IMF. It's a fund, but there is no deeper fiscal articulation between these states, right? So the SDR, the IMF can never write a blank check in the way in which the Fed can or any FIS can, because the deeper articulation into a larger economy is simply not there, right? It's just whatever balances it has. If those balances down, the states are like, well, you're out of money, right? It's not going to kind of, it's not levered on any actual underlying real economy. Of course, there's barely any commercial banking that denominates liabilities in SDRs either, and it completely lacks scale. So what you end up having then at the international system is, if you like, an analogy to private banking, where you have a subunit. The US is a large part, but still remains a part of the world economy, kind of defaulting into its role as national money, because as world money. But unlike what evolved in domestic credit systems, where you sort of nationalized money but kept the banking system private, and then tried to gear the two together with a set of control mechanisms, at the international scale, you have this kind of missing world money. The world isn't a fiscal society. It hasn't come together as a kind of, as a single tax base or as a single political entity. There is no world state. So you have world money, you have a subnational unit issuing world money absent any of the kind of control mechanisms, right? And this is one way to make sense of Kindleberger's idea that one should globalize the control of the dollar, right? He saw, instead of an FOMC, he asked for a kind of Atlantic open markets committee, right? So because it's the US's money, it's the US's liability, but it's our money, right? It's world money to make sense. So he wanted to the US dollar functions, and that it functions as a global public good. So you need to have kind of governance mechanisms adequate to that. But of course, you lack, and no state would do that. So you have a kind of private money dynamic where you have an entity that is issuing money for everyone, but its interests are its own. So US interests sort of dominate world interests, and that itself gives a certain character to the kind of to the world system, a character that I feel like we're kind of stuck with. And this is almost like the geopolitics of money, unless there's actual a balance at a geopolitical level leaning against the US, unless the global system evolves an alternative through the renminbi or through the euro. I'll talk about the euro in a second. Unless the hierarchy becomes a little flatter, unless there's an exit from the US dollar to some other kind of credible alternative, that is the only way to discipline the system at the global level, not by this. Kindleberger lampoons the SDR and various other kind of various other monetary experiments as kind of Esperanto, that they're not articulated. He thought in the daily sort of commerce of international commerce. That's of course true. But that's, I would say, partial, in the sense that that's just talking about economic mutualization. There's even more important and even more critical of flaw, I would say, is that there's no political mutualization. I have a chapter on cryptos and bitcoins. Now, Dan was talking yesterday about how he's like, inserting the on-chain things as liabilities and so on, but they're not. I think it's very important to distinguish between tokens and promises, because tokens are digital tokens and digital ledger entries, but a kind of blockchain ledger is not the same as a balance sheet. It's not a liability. It's not a promise to pay anything. There's nothing on the asset side. There's no assets, right? It's just a thing. It's a digital thing that has kind of artificially kind of artificial scarcity value. And so there's no fiscal articulation there. It has no stability. You could have, of course, they are artificially scarce in the same way that gold was artificially scarce or naturally scarce. And so you can have a credit system built on anything that's artificially scarce. You can have issue claims against it, banking claims, credit claims. And so you can have Bitcoin banks, if you like. And arguably exchanges which came and went were sort of Bitcoin banks in disguise. But they are promising to pay an unstable instrument, so their instrument is going to be itself unstable. Here I'm thinking about, so you can have Bitcoin banks and Bitcoin as the outside instrument, if you like. But because tokens, I mean, we went through this with gold, because tokens are, you can discover, you can predict how Bitcoins are going to grow, but the market is very unstable. They are constructed to be inflexible. Because that's in this imaginary meant to give you kind of stability. But they've confused inflexibility with stability, because in credit money and banking money and the way we have it, we in fact get both stability and flexibility. Bitcoin has neither. And of course, it lacks the granularity. It has some granularity. It's used in some transactions, but very little. And so banking on them, it's no surprise that a banking business is so difficult to build on top of them. I have a slide here. Dan talked about stablecoins yesterday. I guess I've coded them as money market mutual funds. They can be euro dollars. The point is, of course, there's a distinction between inside and outside kind of claims here. I'm thinking here the diagram here is implicitly about something like Tether. There are still no good, rather than Terra Luna, etc. There are no. I'm getting a bit of an echo. But this locking, this is like a kind of private money market mutual fund in the sense that it's a private promise to pay. Take the example of Tether, it's a private promise to pay the dollar. And in that sense, it's a kind of private articulation. These things are regulated to do that. You will recall that in the financial crisis, many private money market mutual funds were de facto nationalized, in that they were given lifeline support from the Fed in order that they don't break the buck. So they were basically backdoor made into banks and regulated as such. But that is a kind of control mechanism coming out. So these kinds of private promises to pay dollars one-to-one, they either break the buck eventually, or they get bailed out and treated like actual banks. And that is, again, because of this distinction between the private promise to pay and the public promise to pay. And lastly, just as a kind of bonus, the RMB and its potential as kind of world money. Of course, strong mutualization, strong fiscal federalism in many ways. And we just saw a very robust local currency bond market in China. I can tell you that absolutely nothing like that exists in India. It's very, very top heavy. Even the federal units, the liabilities of the states, the subnational units, there is a very weak market in them. They're basically buy and hold entities for sub-sovereign debt. But you have all of that sort of playing out in RMB. So, and it's obviously a strong fiscal state. But RMB banks tend to have, from what I can tell, again, I'm happy to be corrected on this by the China experts in the room, but from what I can tell, they have much more domestic orientation. They have a relatively closed capital account. There's, of course, state control. And they do recycle their surpluses globally, but this is not a kind of banking endeavor where they're kind of borrowing short through, the US, Kindleberger's idea of the US as a global bank, borrowing relatively short through treasury bills and doing FDI abroad. This is they have a surplus on the current account, so they have just a cash pile. So they're much more like a kind of money lender in that sense. They're not borrowing to lend, they're just lending their surpluses and putting them into various infrastructure projects, One Belt, One Road, New Silk Road, and so on and so forth. They have the scale, but of course the closeness of the capital account means that the liquidity of the RMB is limited, and they are in fact investing in deeply illiquid things abroad. And so they have the potential scale, but they don't yet have the kind of economic mutualization, certainly not internationally. They may have it to some extent domestically, but certainly not internationally, to kind of challenge the dollar. And from afar, it also seems as if the kind of political and that's an equilibrium politically, because the capital account, even though it may be opening at the margin, I'm sure we can discuss that. There is and notwithstanding all the strong efforts to internationalize the RMB, they have, of course, the kind of parallel SWIFT payment system being built. There's a central bank digital currency system that was talked about that's being built that could yet, these are all steps to internationalize the RMB. But notice that these are all at a kind of apex level. They're not really at a kind of granular capillary level. There is some trading in certain commodities, I believe, happening in the RMB. So that may come on. But there seems to be a political preference for control over allowing a certain banking system to flourish and therefore ceding control to that and making control happen more as through prices rather than through quantities, which we heard earlier. So that's more or less a kind of quick overview of the way in which theory works and the way in which it's kind of applying to the cases. I'm more or less done. The diagram here, the cover of the book is a kind of take, if you know, of Hobbes's Leviathan, and the frontispiece of Hobbes's Leviathan has this entity. The idea in Hobbes's Leviathan is that people come out of a state of nature by forming a political contract, a social contract with each other, whereby they mutualize, their kind of freedom in this artificial god that they create, the Leviathan, which then kind of brings kind of social order and kind of locks them all together to some degree. Of course, they have freedom after that. But the Leviathan is, if you zoom into the Leviathan, you can see that it's just people. It's just composed of everyone coming together, but everyone turned up towards the Leviathan. And the idea here is that this is just political mutualization, but also it's through money, so it's the economic piece as well. So let me stop there. I hope I didn't go on for too long. Thank you.
Well, thank you very much, Anush. Great presentation, great contribution to our discourse. Fantastic.
I can stop.
There's quite a few points in the chat. I hope we can bring them up. Who would like to ask the first question?
Great. I can ask a question. What is the important distinction between gold and Bitcoin in kind of how you think about it? Like, we did have a gold standard and a monetary system based on gold, and you said we could build banking based on gold or based on Bitcoin, but it wouldn't be stable. It kind of was pretty stable under a lot of the gold standards. So I'm wondering if you could kind of speak to that, or if there's any kind of connection there between those two.
Sure. Well, gold and Bitcoin are similar because they're just things. Then they're right, and so they're scarce things that are fungible. Therefore, you can monetize them. But you can therefore create a banking system based on this pen, right? They just promise to pay promises to pay gold, promises to pay Bitcoins. The reason why gold was stable was that it was locked into a political settlement that enabled stability, but only by repressing the income of many people, right? Once democracy came on through labor movements, through franchise movements, through decolonial movements in the global South, the stability of gold went away, right? This is the entire point of Polanyi's story in The Great Transformation, is precisely that you had a kind of collision between the rising democracy and this kind of pledge to gold. And so gold was stable, but it wasn't flexible. And so you needed to replace gold with an instrument that was flexible enough to accommodate democracy. And that turns out to be just us, which is that a more flexible instrument is the national product. And that ebbs and flows with all of us, and we kind of are locked into it. And if you can monetize the national product through this set of balance sheets, then that gives you both flexibility sufficient for democracy, so the fisc can grow, businesses can grow. Mainly the fisc, though, right? The big thing is that the governments weren't big under the gold standard. Governments were a fraction. What did governments do? National defense, right? After democratic revolutions, governments have to do a lot, right? And governments rise to be the largest economic entities in a constituency because they are the largest political. The economic scale comes from their political contract. And even in the US, the state is a leviathan, right? Because now you have to have a welfare state of various kinds. And in fact, that is the original inspiration for this is Perry's idea of thinking about the state as a financial intermediary came out of his thinking of how Social Security is funded, and to think about the state as a kind of social mutual fund. But I expanded that not just to funding Social Security, but to fund the state itself. So that's the analogy and disanalogy with gold.
Great. Lots of hands are up. Dan was first.
Thanks, Jay. I'll keep it quick. Thank you, Anush. I'll keep it quick because you and I have talked about your work more than once before, and we will talk about it more than once again. So I will leave some time for other folks to connect with you now. But thank you for this. And Anush, I want you to know that I'll be using your book with students this semester. And this is a way of saying I think it's a very valuable edition. Connects nicely with all of our many other work within this space, and also at the same time opens it up in a way to conversations about political economy that this well. We've talked about this many times, but I think it's having this book out there in conversation with other money view type of discourse, and then reaching into political theory in a compatible and coherent way, as you've done, adds a lot. So I'm very glad to have it. I'm very glad to hear your thoughts on it today. A question just to put in the mix. I have had on my mind a lot the idea of Jubilee over the years. Jubilee being an idea from monetary history, and I think about Graeber's book Debt in particular, which captures this nicely, which is that if you look at monetary history, what you see is that there seems to be a periodic need to sweep away all debts. When the credit system gets out of whack, somebody has to say this is not going to work, and we're going to cancel everything, and we're going to start again with a fresh slate, clean slate. Not, and importantly, it's not one by one, right? We're not going to go through each debt one at a time and say you're not going to pay, bankrupt, clear your debt. But instead, we're going to stand at the center, sweep the whole thing away, and say this whole thing is not working. Let's start again. And it seems to me that your notion of political mutualization and economic mutualization could speak very directly to the political and economic tension that is at the heart of a Jubilee, which is you follow me. So I'd be curious to hear your thoughts on that. Thank you again, Anush.
No, thanks for that, Dan. No, there's a great paper by an anthropologist called Gustav Peebles who talks about periodic debt forgiveness as well. That I can put that in the reference at some point, in the chat at some point. No, see, Minsky talks about incoherence, right? And that the system can kind of tend to entropy, of course, and that's the whole financial stability hypothesis. But that's, again, economic mutualization. Political mutualization can equally lead to incoherence if debts accumulate to an odious level. And just like Minsky terms, a bailout is a kind of technical, it's like hitting reset on your computer, right? There's too much entropy in the system. You need to flush things out and start again. So it's just a technical requirement of a complex system. Now, of course, because that system is always already politicized, the terms of the bailout, how the technical stuff is going to be achieved is a subject of a big fight, right? That it needs to be done is different from how the pain is distributed of it being done. And I think that's an important distinction. Similarly, so for me, I would see Jubilee as a kind of political reset. When political incoherence, either domestically or internationally, has gone beyond a point. And again, there's a kind of there's a way in which we can think about that, and it's done routinely. I mean, Katerina describes this very nicely in terms of the paradox of finance, right? Contracts need to be stable on the at certain moments in the credit cycle, but if they are too rigidly adhered to, then at all times, then the system itself actually breaks. So I like to think about that in terms of I haven't thought about political incoherence, and that allows me to do that. But thanks for that, Dan.
Gary was next.
Yes. So I've actually read this book and we've had conversations about it. I believe that I blurbed this book. I'm not sure if Cambridge accepted the blurb. I don't remember what I said about it, but
You said nice
um,
things.
must have been nice things. And so I will repeat what Dan said, that I think this is very valuable, that I do think of the money view as social theory. That's what I'm trying to do too. Okay. As a matter of fact. And what you point out is that way back when, my first book, 1997, which I put in the chat there, I wasn't sure which direction I was going to go, the money interest or the economic history. And basically, I've spent my life building out one side of that. Okay, and so because you can't do everything, and so I'm happy that somebody is building out the other side of that. I have 2 points. One, now that I've heard your motivation a little bit, which I guess I was aware of, that you want to understand where does the hierarchy come from. I remember you being uncomfortable with that 20 years ago. Is it credit all the way down? It has to attach to something material. And uh, so I guess I want to raise a question in order to push this discussion further. Does mutualization at scale do all the work that you want it to, for understanding hierarchy, and understanding the varieties of mutualization at scale? Are they doing enough work for you? So partly that's about the political versus economic, which you claim that the political scale is stronger somehow, and I want to question that too. From over the last 20 years, I have come to view time as an important dimension of this, in fact, crucial dimension of this, because the settlement constraint is about time. It's about promises in the future. We don't test those promises until they actually come due, okay? That moment. So what does that suggest? It suggests that hierarchy is about who is a structural surplus person, right? They have net positive cash flows coming to them. So they can make a promise to pay tomorrow because they have net positive cash flows coming to them. Now they may not have this, every period, but perhaps they have the ability to force net positive, you know, cash flows in their direction. So even as a contingency, this gives them the ability to issue liabilities that count as money. None of that is that may, I think that's compatible with your framework, but it's not sort of there, that importance of time and this notion that surpluses and deficits are what's getting resolved at the settlement. And so that's the first point. The second point, and this is related, you state that political mutualization is more robust, stronger than economic mutualization. And perhaps that's true in the United States, okay? But I don't know that that's true as a matter of logic. And it's certainly not true as a matter of history, okay? That if you look at the history of the British state, for example, in order to fund their wars, they had to make an accommodation with the bankers. The state was unable to fund its wars without the help of the bankers. Okay, and that was where there was a connection between. But of course, that was before it was a democratic state. It didn't really have tax authority, so it had to borrow. And the consolidation of the British debt, the famous consols, was an important step in that. But still, the money was the Bank of England, which was a private bank. You might be interested in writing about this. That it was Bagehot who invented the Treasury bill. Okay, for
Wow.
for the Bank of England, for the Treasury. And what was he doing? Okay, what he was doing essentially, okay, was saying, well, what is the instrument that makes most sense for banking? It's commercial bills, it's commercial paper, it's short term, it's 3 month stuff, because that gives you the cash flow, that it's going to mature in 3 months. So the natural banking instrument is about time. It's a short term instrument, not a console. Okay. And so let's let the government issue those things too. That's essentially what a treasury bill is copying the maturity that has developed in the economic mutualization world. Okay. And so that their treasury bills could be good bank assets. Okay. Which they weren't before. So to finalize this, this is the point that mutualization, a mutual fund that is holding equity, okay, their liabilities are not money. A mutual fund that is holding bonds, their liabilities are not a competitor of money, okay? Maybe a money market mutual fund, okay, starts to be able, but even then, and we've seen the change in regulation that unless it's treasury bills, you're not allowed to promise par settlement, in money market mutual funds anymore. That it is banks, there's something special about banks, and it's not just mutualization. That's what I'm saying. So that I don't think mutualization at scale is really is giving you the deep understanding of where hierarchy comes from, which is where you're motivated for in the beginning.
Yeah. No, thanks for that, Perry. Great questions. But I think the clue is there in that money market mutual funds backed on treasury bills can issue, checking accounts and so on. What is it about the treasury bill? So let me come back to that. Time is definitely there in the sense that the economy is a going concern, and sovereigns are seen as kind of infinitely lived, right? And the ability of the state to issue 30-year bonds, say, consols even, infinitely lived bonds, but certainly 30-year bonds, right? No private entity can, in principle, claim to be infinitely lived, right? There is a convention, but there's also the facticity of the kind of antiquity of states, certainly modern states, vis-a-vis the ebb and flow of banks, vis-a-vis the ebb and flow of the dynamic ebb and flow of so the nations are considered to be kind of going concerns and infinitely lived, and because they're going concerns and infinitely lived, they have a time horizon that, and why do they have that longer time horizon? They have that longer time horizon. This is exactly the kind of intergenerational social contract that we have, right? Is that because there are as yet unborn taxpayers who are going to contribute to the state. Apple Computer can't say that of its customers. Goldman Sachs can't say that. Citibank can't say that, right? Because we are already, so it's something in the nature of, and indeed the scale of this form of mutualization that gives it the longer time horizon, right? And so the time horizon is endogenous to the type and scale of mutualization on the one hand. And that's precisely, so because you always already owe tax, that's the way to force cash flow to this balance sheet, right? But the forcing of the cash flow to this particular balance sheet is not an economic forcing. It's, if you like, a political forcing, but that's a consensual political forcing, right? That the state can concentrate cash flows on itself to its own balance sheet over a terribly long time horizon. I mean, some of the Napoleonic debt was just paid off, like whatever, in the 1940s or something. It was a seriously long kind of smoothing of this, right? But that brings me to this point about of the Bank of England. You're absolutely right, of course, to note that it's with the bankers that this deal was done. But it was what then, and this is where Ingham is his strongest, I think, what then emerged out of this political deal was a different kind of state, right? It was king in parliament. It was a different political settlement. The bankers are not giving the money to the state for nothing. They're like, you give us some sovereignty, you give us parliament. It wasn't a democracy, but it was an oligarchy amongst power brokers. It was a political settlement that then enabled the bankers to open the coffers, and then give the Bank of England, right? The French didn't have this, right? This technique of taking the bankers' horizon and turning the commercial bill into an instrument of government finance is, the British learned it from the Dutch, and the Dutch learned it from the Genoese and the Venetians, and so on and so forth, right? Venice is basically a country run like a corporation, or a city run like a corporation, right? So it's when you have a particular kind of political settlement wherein the bourgeoisie, the traders and the bankers become the state. I mean, the Venetians and the Northern European city-states took it to a kind of particular degree, but they could only scale it up to they were small independent city principalities. When you annex that kind of government finance machine to this feudal state, which is what the Dutch did, and then the French, and then the British did, and so on, then you get this combination, as this raising up of the kind of commercial bill to a tool of government finance, and that is a killer weapon, because once you can do that, you can precisely stretch your survival constraint of the state much further in a geopolitically competitive way, which is of course why this technique was then copied by everyone, so that everyone's like, the empire has it, we need it, right? And then you have this. So the political mutualization is stronger than economic mutualization only as a kind of ideal type. This is not. As you say, there are many cases in history where the opposite is true, but the fusion. That's why your point about essential hybridity is so important. It's precisely the fusion of these two kinds of mutualization that is built on top of a kind of political revolution of the commercial financial elite, the money interest, they moving into the state and taking charge of the state. And by the way, where that hasn't happened, the money is poorer, right? It is not as good money. This is the point about how is the power distributed between financial elites and state elites in China, right? Or in India, or in other countries, right? So that modus vivendi between the state elites and financial elites is super, super important, because it's unlocking this crazy weapon, this crazy bit of monetary infrastructure, which enables the state to relax the survival constraint, because it's doing it at super scale, which, by the way, is good for capital, because capital likes a constructed monetary space, right? Eric Helena has this lovely book about building national currencies and so on and so forth. That you don't want multiple currencies in one national jurisdiction. There's a lot of transactions costs and so on and so forth, right? So it puts capital on a firmer footing as well. So it's a win-win in ideal time.
So just a quick view of the time. I think we have maybe 5 more minutes. 2 more questions and a quick response from Anush. Then
Shall I take the questions together? Yeah.
Yeah, let's do this together, Karen and Chris.
Okay, thank you. Well, I wonder what you think about the dollar system dominance. Is the dollar system dominance, has it come about through the private capital markets or through the Fed's action? I would say that it seems to me that it was really the private dollar that was winning the game, and not so much the Fed, which is helping and assisting the euro dollar, the private dollar, and not the other way around. So I think that this thing about political and economic mutualization is a bit too schematic, because it really is intertwined in many ways. I have some very concrete questions. You said in your sort of three-part balance sheet that GDP was on the asset side and tax on the other side. There are certainly also other things on the liability side than taxes. It seems to be there's no equivalence between GDP and taxes, and otherwise you would be pure chartalist anyway if you think so. That was one thing. And the other thing you also said was that bank money was smaller than national money, and you had some arguments which I didn't really catch, but anyway, quantitatively, it's certainly not true. And putting it together with your balance sheet, in that balance sheet, you have absolutely no finance. It's all sort of equal. Government bonds and national money are equal, and that's the whole monetary story. But that doesn't really capture, definitely not the money view, and definitely not reality. So let me stop here because we don't have so much time. I would like to talk about gold also. Gold has always been produced as a real commodity. The perverse thing about the Bank of England price of gold was that it was fixed for 200 years, whereas, of course, as a produced item, it has various production conditions and should vary in price. And I will also query the question whether gold is out of the system this day. Just because it's not in the official system doesn't mean that it is not in the banking and central banking system. I think that's a discussion that one ought to have at this level of the money view a little bit more in depth. Thank you.
Thank you.
Okay, and the point I was going to say was, I'll try and be quick, because I'll join the reading group, but I'd like to discuss something I've been talking about on Twitter recently. It's about the idea of money as a claim on GDP, and I think really an IOU has to be a claim on a specific legal entity, but that's something to think about, and we can maybe discuss it in the reading group.
Thank you, Chris and Karen. I'll just answer a couple of Karen's questions in the interest of time, although all of them are interesting and worthy of thought. Private dollar versus the public dollar. Now, of course, you're right that, and this is the point about stability and granularity, right? In order to articulate into an actual lived economy, you need to be granular. You need to be on the ground, right? You need that, and that builds a set of kind of economically mutualized balance sheets. And that kind of, they are, if you like, the outriders of the system, expanding the dollar system in that particular way. But of course, don't forget that the private dollar is a promise to pay the public dollar. And if those promises go bad, the private dollar system goes bad, right? We've had, I mean, the Fed very quickly found itself to be basically backstopping the Eurodollar market, right? And then we have credit, central bank swaps and backstopping much of the European banking system, because they're functionally tied up together, right? And so I think it's both, Karen. That's the whole point about about having a combination of mutualization, right? You need the expansion of the economic and the granularity and the flexibility and liquidity of the economic, but you simultaneously need the scale and credibility of the political, and it's their braiding together that makes this and at scale that then kind of does the work. By bank money being the greater than sign, sorry, I wasn't thinking about it in quantitative terms. I was thinking about it in qualitative terms. That it's you're of course right. Most money is in any system is bank money, but bank money is a promise to pay something better, which is central bank money, outside money. So that was the greater than sign there. Chris, this is a very important point, that it is not an IOU to pay another instrument. That's absolutely right. And there is a bit of a fudge there, because is it more debt-like or equity-like? Because it's a promise to pay value right. It's not a promise to pay an instrument. That's exactly right. Unlike bank money, or unlike money backed by gold or something, it's not an IOU in that sense. It isn't. It is so if it's a promise to pay future value thrown off by the economy, then is it a form of debt or is it a form of equity? And even equity has a cash flow component to it, but it has a more kind of value orientation. So that is a difference between the kind of formatting of the value. But it's the same way as a kind of non-financial balance sheet has production on the asset side, right? I mean, you do have value being produced. So that's the way I kind of think about it. But you're right to say that it's not an instrument type promise; it's a value type promise.
Well, thank you very much on behalf of the whole group, Anush, for the presentation, the book. We'll read it very soon. Join the reading group. You find the details in the comments. Yeah, this opened up a whole new spectrum of discussion for us, as you can see. Thank you very much.
Thank you guys. Thank you for engaging.
Great discussion.